Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Wednesday, February 3rd, 2020. And what I'll do in this video is take a look at the broad markets. There's a few things I want to point out, some developments today. I was going to say not a lot new to report, although so far we're back above that trend line in QQQ. As you recall, I was wanting to see what happened to both Alphabet and Amazon after they reported. So I'll get to that, and we're just going to do a quick update on the FAANGs and the market, and then one of the developments I'm noting today. And again, a lot of what I'm looking at in my expectations hinge on what happens here with the euro and US dollar. I pointed out, we've seen the biggest disconnect between the tight correlation or inverse correlation between the stock market and the dollar, which is, of course, a positive correlation when you use the euro US dollar pair. Euro's up, dollar's down. So we do have the breakdown, and we continue to confirm that breakdown today with an additional red candle. But we're sitting really right about where that key support was I showed you yesterday on the U.S. dollar futures. We haven't really broken out impulsively, and same thing on the E7 euro futures. But again, it is a breakdown, and what I wanted to show you is, and I've gone over this many times, I'm going to turn off these lines. I want to show you the correlation here with the S&P, and again, one of two things that are most likely to happen. So I'm going to put on the S&P 500, overlay it here, and point out 3 periods. We'll go back a couple years. I'm rolling back here. You can see an almost perfect correlation here. Again, the lines aren't going to overlap. You want to see one going up, the other goes down, inflection points around the same time. And what you notice right here, this was a big comparable to this current divergence. I'm right here. This is the current divergence I'm talking about. There's the euro US dollar pair falling, or the euro falling against the dollar rallying, and there's the stock market at or near all-time highs, and it looks even more pronounced when you put on QQQ. But either way, you can see one going up, the other going down, which is quite unusual. Okay, let's go back here. So as you can see, they were tracking well together, and then at this point in time right here, particularly right about here, we had a similar very stark divergence where the stock market was going up and the euro was falling, dollar was going up, and then what followed was the biggest drop that we've had in years, from the decades really, over that short period of time. And again, I've talked about it quite often. There was plenty of technical evidence in place for a correction before the COVID lows, just like we have right now. But we finally had a catalyst. And yes, COVID, the shut down the economy, certainly exacerbated that sell-off. But again, at the time and throughout, it was, telegraphed in the charts, the same kind of bearish divergence as everything else I've covered. So wanted to say that one, you had the divergence, and the mean reversion, in other words, the two come back, was after the market went up, ignoring the drop in the euro, rise in the dollar. It manifested. The mean reversion was for the stock market to correct sharply. Euro did come back in as well, but again, it triggered that correction. Now, we had a similar, or I should say, up until this current divergence, the biggest divergence was right after that drop into the March lows. Again, that's last year, 2020. And you can see the stock market was rising as the euro was falling, and then euro kind of flattened out, and it was the euro that played a game of catch up. So look, I will acknowledge, and I've said it again and again, this divergence will manifest most likely in a mean reversion. It's going to be one of two things. It'll be euro up, along with the stock market continuing to hold up or build on its gains, or stock market down. And now what I wanted to speak to here, as I said, there was plenty of evidence. We had the negative divergence in the indexes. And so again, it was priced in that we were going to get the drop in the market. Back here, this time around, after the March lows, the opposite happened. We had positive divergence on the S&P 500, bullish divergence, extreme oversold conditions, and so the technicals favored the bounce in the market. And not continued drop in the euro. And so that's what happened. The market went up, and finally the euro played a game of catch up. That's all I wanted to point out is these mean reversions, or I'm sorry, the disconnects, the divergences, First of all, they can continue for quite a while, so this may go on for a little bit longer, or not. And again, it may result or finally end up with the euro rallying it to play a game of catch up. In other words, this little divergence here was just maybe I don't call it a whipsaw. That wouldn't be the right term for it, but again, may not result in a correction. I still think that's where it does because of everything I've talked about now for weeks, going on months. This chart being one of many reasons right there. The put to call ratios at extremes that in the past when we hit these extreme levels, that red line have signaled some of the biggest drops that we've had in the stock market throughout the bull market here. And this one is just one massive cluster of extreme readings that signal, again, I'll continue to say it, I think the next correction, the odds right now, let me be careful with my words. I believe that the odds for a market crash right now are higher than they've been for a long time, and at least going back to last year. So whereas and I've said this just in the last week or two, I've started to shift away from looking for a correction to more of a crash. When I say a crash, very swift drop, doesn't mean the market's going to go down to zero, but a very swift and powerful sell-off that will probably far exceed a 10% drop. It'll be well into the double digits. Most of my targets right now, I'm looking at different things like the semis and tech and all that, looking probably a good 15% drop before we get a decent bounce is what I'm thinking, give or take. Okay, so here's what I wanted to talk about today. Is what stands out to me. I'm pouring over the charts. One of the things that stands out is the market breadth in the Nasdaq 100, the amount of stocks up versus down. So this is QQQ, tracks the Nasdaq 100, and that's one of my big go-to indexes. Very tech-heavy, very heavily weighted with the market-leading stocks, more so than the S&P 500. So it's a really good tell on where the stock market's going. And I mentioned yesterday when we zoom in that we had regained, so we had that breakdown on Friday, regained the trend line yesterday. I said, take it with a grain of salt because we have the last of the two big fangs reporting last night, and they're out of the way now. Alphabet and Amazon. I'm going to get to that in a second. I also went over the recent history where the majority, I think it was all but one of those market-leading FAANG stocks, plus Tesla. I'm grouping that in there now because now Tesla is up there in the top 5. So it's actually, now we'll call it FAAMG+T. You'll have to include Tesla because of the weighting in there and the market cap. And so, as I said, Microsoft was the only one that has actually posted gains and rallied since their earnings in the last couple of weeks, whereas all the rest sold off and remain below that level. And so just quickly, just to let you know where we're at today, you've probably checked these stocks. Alphabet is up, and it's up big, and it's put a big weighting on the index. So here's where I'm going. I'm going to look at Amazon for you. Amazon's down, been down all day. So here's another one it's been a consistent trend. The market leaders, look, they're not going down, but they're not going up, and they haven't been going up for many months. This is Amazon, trading at levels now. Actually, right today, if I grab today's low, let's turn off all these lines. Or no, where we're at this very moment on the crosshairs. That's exactly where the stock had peaked out on right back here, and that was July 13th. So you can see it's gone up a little since then, down a little since then, and it's indicative of most of these big market-leading FAANG stocks. So again, while they're not going up, they're not going down either. It looks like a saturated trade, and meaning just the majority of individuals and institutions have their fill. Anyone that's been bullish or is currently bullish or has been for a while has bought enough Amazon and has bought enough Alphabet. The companies continue to their earnings juggernauts. So I'm not knocking these companies fundamentally, and I'm just pointing out a condition in the market that is cause for concern. When the market leaders fail to continue to go up and make new highs, that is quite often what you'll see before a significant top. Now, as I've said many times, this may be a period of consolidation. They may break out to the upside. Microsoft has, but that's about the only one and the rest are still kind of sucking wind. So that's it. I just wanted to mention now that we have one up, and let me show you what it's doing today to the indexes, that Alphabet, GOG. So here's the NASDAQ 100. I'll turn back on the trend lines. Now I'm going to show you what I've noticed today. This is a list of all the holdings in the NASDAQ 100 index. There's actually, you can see down at the bottom, probably can't see that in the video, it says 102 items. Why in the NASDAQ 100 are there 102 items? Well, two of the companies, including Alphabet, have two share classes. So that makes it 100 companies, but two of those companies have two different share classes of stock, such as GOG and GOL. And now what I wanted to show you here is of the 102 individual stocks within the NASDAQ 100, I've just sorted by gains. Look up top. I don't know if you can see it. 9.38. That is, and remember, Alphabet has an extremely large weighting on the NASDAQ 100. All the other companies that are green are much smaller in market cap. I don't have the weightings up on this watch list. I have it on another one to the left. But what I do here is I click. If I click on the very last one, which is Cognizant Technologies right here, now that's no longer green, so now I have to click on AXLN. This tells me down here 28 stocks are trading positive, one is flat, and the rest are, which is the bulk, over 70 companies, 72, 74 companies right now are trading down. That is unusual. So, and you can also see that in the fact that QQQ, let me close this list, go back to QQQ. As I said, it's trading up 0.02%, so positive on the day, has been most of the day, and that is 110% attributed to Alphabet. Alphabet, GOG. If you strip out that big 9% gain with their heavy weighting, what you get is, here's the equal weighted NASDAQ 100, QQQE. This just applies an equal weighting to all those companies, and it's been down all day, and to the tune of about a 1%, close to a 1% differential. Right now it's about 0.9%. Earlier today I noticed it was about 1%, meaning we're down here 0.75% right now on QQQE, and up about 0.2% on QQQ. And that's something to note. I always say this: one day doesn't make a trend, but again, that tells me that there's under the hood quite a bit of distribution going on in the NASDAQ 100, and when the futures are up, because the futures don't apply equal weighting. The futures are tracking similar to QQQ. So I just wanted to say that, and then say, here's a trend line that I have on QQQE, worth watching as well. Remember, I already had QQQ breakdown, but then snap back up. So where I'm going with this is today I'm kind of going to give it a question mark. In the beginning of the day when the market's open, I could see the futures up. I was going to give it a check mark for the bulls and saying that breakdown, the whipsaw, I've been talking about that the last few days. Said we broke down on Friday. There was a sell signal that confirmed the recent sell signal in SPY. I'm going to get to SPY in a second. Then we closed on Monday right on the trend line. And then yesterday we gapped above it, or gapped above it and closed above it. But I said I had to, put very little weighting because we had those two big fangs coming up to report. So the bottom line is, of the post earnings, Amazon, like all others but Microsoft and Alphabet, are down since earnings in Alphabet. So I'm seeing a distribution in the market leaders, and although right now, and I've said it before, you can't make a case to short or add to any shorts, but I'm going to sit tight with what I have, and I'm going to give it another day here and see if this one day event here sort of morphs into a trend where we see more selling, more distribution. Again, you can go down the line in QQQ. Let me go back to market cap weighted, and you can look at stocks like Apple, which broke out. There was the arrow for the earnings. Apple's still down, still above this trend line, and as I said before too, you cannot go, or at least I can't go, to a hard all-in sell signal until Apple breaks this trend line. So far it's held support. It bounced there, but the bounce has been very muted. So there's your post-earnings sell-off in Apple. the largest of the components. Microsoft, like I said, best of breed right now in the big market leading stocks. It has broken to new all-time highs, has built on its post-earning gains, but that's really an outlier compared to the rest of them. There's Amazon selling down, not big, but nonetheless down 1% after just announcing a huge earnings, huge profitable quarter. And there's Alphabet. Alphabet, that's the GOGL. Here's the other share class I had marked up. This was the wedge pattern I had. We basically moved the line. The divergences are still intact, but you can't take anything away from this. That's a powerful post-earnings move. And it also says here's, now 2 of the 5 FAANG stocks have broken out to highs. So I will definitely give check marks where check marks are due. 2 of the 5 get the check marks, and of the rest, which again, Apple I already covered, Amazon, which I already covered, Tesla, which I've covered recently, sold off after earnings, a little arrow. Facebook sold off, there it is, there's the arrow after earnings. And even it's a couple down as far as market cap goes, but Netflix as well. Netflix, I know that earnings right here, they reported that day after the bell. There was a gap up the next day, so it did gap up after earnings, and they faded most, not all, but most of the gains. And again, story is it remains another big market leader that remains in a multi-month sideways trading range. It goes all the way back to June of last year, and we're back in it. So there it is. That's the common theme. So this, coupled with all the divergences, which still, that is a big part, I think, as you know, of my analysis, talking about negative divergences for the first time since before the big drop into the COVID lows on the indexes, on many stocks. I call the COVID lows that drop, and here it is right there. Yeah, we had divergence there on Netflix. And of course, the indexes, more importantly, a lot of the indexes had negative divergence on that drop, before that drop. And so that's about it. I don't have, I've kind of shied away now from new trade ideas. I'm, personally doing less and less trading lately. This market's getting very frothy. This divergent high, this is NQ. I should have let you know what I flipped over to. The NASDAQ 100 futures, simply extending the divergence on this marginal new high. And again, it was, we had this little divergent low here. So it's wash, rinse, repeat. Look for these divergent highs. You get the corrections, little divergent lows, resumes a rally, divergent high, correction. That was actually also a divergent high there into a divergent low. Set the stage, divergent high right here, correction, divergent low, and now a divergent high. So we'll see if this one plays out. And again, I'm referring to this larger divergence right here, which is really an extension of this previous divergence there. With the trend so resilient, you want to give it the benefit of the doubt. What I'll do right now is drag this trend line down. I had it nice and clean there. We had that little whipsaw, but that is now a reaction that didn't exist, a candlestick before. So I'm going to come down here, clip the very bottom of that candle there. Before, on that candle from November 2nd, I had the body of that candle, the fat part. Now I'm going to get the skinny part, the shadow. And I'm going to come in here, and that's going to show, we're right under, well, it's about where I had it before, give or take. So what I want to see happen, need to see happen to get some downside is Apple. Again, this purple trend line here, I think I have an alert on that, and then Tesla. Those are the 2 big ones. Not that there aren't other big companies in there, but those are the ones that have, to me, pretty clear, well-watched levels. I highlighted this before, about 800 in Tesla. We came and tested it the other day. So far, a relatively muted bounce, and that would, if Apple and Tesla take those levels out, I think you'll see some of the other big market leaders go down as well. And until then, like I said, there's a lot in the charts pointing to the potential for correction. We need that catalyst, and the catalyst is a breakdown. We had it, last Friday on when the Qs took out that trend line. SPY already took it out. SPY is back testing, so a case can be made there too, as it always is. When you have a security breakdown below support, a well-defined trend line in back tests, it's always an objective time to short. But you can hear it in my voice again. I've been saying it. You got to temper that right now with this resilient uptrend. You need to see a little bit more evidence, and that would be Apple breaking the trend line, Tesla breaking below that trend line. Give you QQQE if you want to watch that. There's that trend line. It fits a little even better on QQQE than the one on QQQ. Again, that's the equal weighted. And unless that happens, you know what? It's yesterday was Groundhog Day, and that's I was going to make a comment about that when we snap back above the trend line in QQQ. More of the same. The groundhog saw his shadow, and it's the uptrend continues. So we need a little bit more, and those are the levels to watch. I'm even going to give you a horizontal level here that I think will help do the trick on QQQE. Because you have several reaction highs here, and you have a breakout candle there, and you back tested. So about 79 and a quarter or 75 and a quarter, so on QQQE. Otherwise, we continue to grind higher. These divergences will continue to build, and nothing, at least anytime soon, will change on the technical outlook. And just to wrap it up here, I'll leave it where I posted this morning. Here we are at what was and still is my final near-term target for this divergent low and the breakout on dollar futures. So, surprisingly, not shockingly, but surprisingly, I got the call right on the dollar, but it hasn't correlated into downside in the dollar-sensitive assets that usually go down when the dollar goes up, and that is oil, the stock market, everything I've showed you quite a bit lately. And so here it is. So the stock market, oil traders, they believe this is the end of the run for the dollar, and it may be. That was, you can see it's only the final target I listed on the chart, but it's also a big level. And I'm not going to get into it now, but I've showed you on the longer term chart of the euro and the US dollar. I can see some more downside in the euro, more upside in the dollar, and still leaning that way. We just need to break out solidly there, and it's not just about the dollar index. You want to look at the top weighted components like the euro as well. Broke below the support recently, and I think this is what others probably see that do trade, incorporate the dollar and the euro into their trading for the equity markets and oil and stuff. They probably see this divergence and expecting to play out, and maybe it will. It's a big old bullish falling wedge. So if the euro can reverse, technical bullish event number one would be to regain back my former first target, which was hit from this divergent high and the breakdown there. We moved down, hit T1 zone, then consolidated there for a while, then hit T2, hit it again, then broke below it. So it is resistance, and so I'm viewing it as that will be a likely stopping point for any, or we already broke down. Maybe we kick back up there or not. Maybe we hit that downtrend line and we move down here. And if that happens, let's just say I'd be even more surprised if the stock market doesn't come under pressure. We've already had a pretty good drop here in the euro, and the stock market has, for the most part, shrugged that off. We dropped down to T3, and I think the odds are very, very low that the market and those other dollar-sensitive assets won't take notice. Now, we turn around and regain that level here. I know I've got a lot of lines going, but if we regain this this support zone, former support, now resistance zone, especially break out above the downtrend line, that's nothing but bullish right there. And that would send the euro higher, the dollar lower, which should be bullish for the stock market, and that means the euro is going to play a game of catch up. The dollar will catch up to the downside, and the stock market rally will continue. Not my primary scenario, but one that you certainly want to respect if it breaks out and you're short the euro, long the dollar, or short equities. Okay, 24 minutes on the button. I'm going to wrap it up here and get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.